There is a sign, a signal that flashes in the real world, far away from the ticker tapes and the quarterly earnings calls. It doesn't appear on a balance sheet and you can't calculate it with a formula. Most investors, their eyes glued to spreadsheets and financial news, are completely blind to it. Yet, this one sign is one of the most powerful predictors of explosive long-term growth a company can ever possess. It's the quiet hum of a business so dominant, so beloved, that its own customers have become its most passionate, most effective, and entirely free sales force. This is not about sentiment. This is about economics. It's about a competitive advantage so profound it borders on unfair. Warren Buffett, over a lifetime of legendary deal-making, didn't just notice this sign. He made it a cornerstone of his entire wealth management philosophy. He understood a fundamental truth that escapes 99% of market participants. The most valuable assets a company owns are often the ones that an accountant cannot record. He knew that when you find a business that has turned its customers into fanatics, into evangelists, you have found a potential gold mine. You have found a company with a hidden growth engine, one that costs nothing to run and is nearly impossible for a competitor to replicate. Ignoring this signal, focusing only on the cold, hard numbers, is the costliest mistake an investor can make. It's the mistake that causes you to look at a company like Apple in 2005 and see an overpriced electronics manufacturer, instead of seeing the seeds of a cultural and economic empire. It's the mistake of focusing on the price of a cup of coffee instead of the loyalty of the person buying it. Today, we are going to retrain your eyes. We are going to teach you how to see this signal in the wild. We will deconstruct the psychology behind this fanatical loyalty and translate it into a tangible framework for your own stock picking and stock analysis. This is not just another tip for beating the market. This is a fundamental shift in how you view the very nature of business value. A shift that can put you on the path to true, lasting financial freedom. We begin by uncovering the most powerful defense a business can have, an intangible fortress that wards off competitors more effectively than any patent or price war. This is the story of the intangible moat. Warren Buffett and his partner Charlie Munger have a very specific vocabulary when they talk about great businesses. They speak of castles and moats. The castle is the business itself, its operations, its profits. But the moat, that's the crucial part. The moat is the durable competitive advantage, the thing that protects the castle from invasion by competitors. For many investors, a moat is a patent, a government license, or a low-cost production process. But for Buffett, the most formidable moats are the ones you cannot see or touch. They are the moats that exist only in the minds of customers. The foundational anecdote that cemented this belief for him didn't take place on Wall Street. It took place in a candy shop. The year was 1972. Buffett and Munger, through their holding company Blue Chip Stamps, were looking for businesses to acquire. They were approached with an offer to buy a company called See's Candies. On the surface, it was an unremarkable business. A family-owned confectioner based in California, selling boxed chocolates primarily on the West Coast. The financials were decent, but not spectacular. The asking price was $30 million, while the company had only about $8 million in tangible assets like factories and inventory. This meant they would be paying a massive premium, a $22 million charge for something called goodwill. In the world of traditional value investing, this was heresy. You were supposed to buy businesses for less than the value of their tangible assets, the famous cigar butt approach of buying a struggling company with one last free puff in it. Paying a huge premium for an intangible concept like a brand name was seen as foolish speculation. Munger, however, had been a long-time resident of California, and he saw something that the balance sheet couldn't show him. He saw the behavior of the customers. He saw the long lines at See's shops during Christmas and Valentine's Day. He saw that when a man in California wanted to apologize to his wife or celebrate an anniversary, he didn't just buy any box of chocolates. He bought See's. The box itself, with its iconic black and white branding, was part of the gift. It signaled quality, tradition, and care. See's wasn't just selling chocolate, it was selling a solution to a social problem. It was selling nostalgia and affection. This customer loyalty was so intense, so ingrained in the culture of California, that it acted as an invisible shield around the business. A competitor could open a shop next door, sell chocolates for half the price, and they would still fail. Why? Because the customer wasn't just making a transactional decision based on price, they were making an emotional one. To buy a cheaper brand felt like being cheap with your affection. Buffett was initially skeptical. The price seemed too high for a small, regional candy company. But Munger was persistent. He convinced Buffett that they weren't just buying factories and recipes. They were buying a decades-long relationship with millions of customers. They were buying a brand that had the power to consistently, year after year, raise its prices without losing its devoted following. They made the deal, paying the $30 million. It would become one of the most important investments of their careers, not just for the money it made, but for the lesson it taught. See's Candies became their prototype for a perfect business. Over the decades, it has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, requiring very little additional capital investment. It was an absolute cash machine. That $22 million goodwill premium turned out to be the greatest bargain of all. See's Candies taught Buffett that the most valuable competitive advantage, the widest possible moat, is a powerful brand that resides in the customer's mind. It's an asset that never wears out, never becomes obsolete, and actually grows stronger with time. He learned that when customers are fanatically loyal, they insulate the business from the brutal forces of competition, allowing it to earn exceptional returns on capital for decades. This single transaction reshaped his entire approach to long-term investing, moving him away from buying fair companies at wonderful prices and towards buying wonderful companies at fair prices. The wonder, he realized, was almost always found in that intangible moat of customer love. The magic that Warren Buffett and Charlie Munger saw in the lines outside See's Candy stores wasn't just good marketing, it was a powerful demonstration of deep-seated psychological principles at work. The fanatical loyalty that creates an intangible moat is rooted in the very wiring of the human brain, specifically in two cognitive biases, social proof and in-group bias. Understanding these is critical for any retail investor or entrepreneur who wants to identify true brand power. Social proof is the tendency for people to assume the actions of others reflect the correct behavior for a given situation. It's a mental shortcut we use to navigate the world. If a restaurant is packed with people and the one next to it is empty, we assume the busy one is better. We don't need to read a review or analyze the menu. The crowd has made the decision for us. See's Candies was a masterclass in social proof. The long lines snaking out of their stores during holidays were not a sign of inefficiency. They were the most powerful advertisement imaginable. Each person in that line was a walking, talking endorsement of the product. Their willingness to wait signaled to every passerby that what was inside was valuable, desirable, and worth the effort. This creates a feedback loop. The lines draw more people, which makes the lines longer, which in turn reinforces the perception of quality and desirability. For a potential customer, the decision-making process is simplified. The question is no longer, "Is this good chocolate?" The crowd has already answered that. The question becomes, how can I get some of that good chocolate that everyone wants? This is why beloved brands often feel like an inevitable choice. Think of how people refer to certain products by the brand name itself, asking for a Kleenex, not a tissue, or to Google something, not to search for it online. This is the zenith of social proof, where the brand becomes the default, the socially accepted correct choice. For an investor, spotting this in the wild is a leading indicator of a powerful competitive advantage. Are people waiting in line? Is the product consistently sold out? Do people display the brand's logo with pride on their cars, their clothes, their laptops? This isn't just vanity, it's a public declaration of correct choice, a signal to others that this brand is the right one. This brings us to the second, even more powerful principle, in-group bias. Humans are tribal creatures. We have an innate need to belong, to be part of a group that shares our values, tastes, and identity. Brands that understand this don't just sell products, They create communities. They create an in-group of users, and in doing so, they automatically create an out-group of everyone else. Owning the product becomes a badge of membership to an exclusive club. The most potent example of this in the modern era is Apple. For decades, owning an Apple product wasn't just a technology choice, it was a statement about who you were. You were a Mac person, not a PC person. You were creative, a forward thinker, part of the Think Different tribe. This identity was so strong that Apple users would fiercely defend the brand against any criticism, not because they were defending a corporation, but because they were defending their own identity, their own tribe. This is the intangible moat in its purest form. When a competitor launches a new product with better specs or a lower price, they are not just competing on features. They are asking a customer to betray their tribe, to renounce their identity. That is an incredibly difficult and emotionally costly thing to do. The switching costs are not financial, they are psychological. This is what Buffett saw in See's candies. Giving a box of See's was a signal that you were a person of good taste, someone who understood a Californian tradition. Buying a different brand felt like a social misstep. The brand had become part of the customer's identity. As an investor engaged in qualitative analysis, your job is to look for the signs of this tribe formation. Do customers refer to themselves as a specific type of user, like Tesla drivers or Peloton riders? Is there a vibrant online community of users, sharing tips, stories, and defending the brand? Does the company foster this sense of community through events, forums, or exclusive content? When a company has successfully cultivated an in-group, it has built a moat that is almost impossible for a competitor to cross with a bigger marketing budget or a cheaper product. They aren't just selling a product anymore, they are selling belonging. So how do you, as an investor or entrepreneur, move from understanding this theory to applying it? How do you systematically identify this intangible moat of fanatical loyalty? The answer is to create a practical mental model, a blueprint you can use to evaluate any company. We can call it the brand loyalty audit. This is a checklist of questions and investigative techniques that go far beyond the numbers on a 10K report. It's a way to perform your own qualitative analysis and get a real feel for a company's relationship with its customers, a crucial step toward achieving portfolio growth and financial freedom. Step 1 of the audit is to analyze repeat purchase behavior. The first and most fundamental sign of loyalty is whether customers come back. A single purchase can be driven by a good advertisement or a temporary discount. A lifetime of repeat purchases is driven by love. Your task is to find evidence of this. Look at customer reviews. Are people saying, "I've been buying this for 20 years," or "I'll never use another brand"? Look for subscription models or loyalty programs. Do they have a high retention rate? If the company doesn't disclose these numbers, look for proxies. For a restaurant, are the same faces there week after week? For a software company, are users on forums talking about how they've used the product through multiple versions over many years? This isn't about one-off sales. It's about lifetime value. Step 2 is to measure Net Promoter Score, or at least its informal equivalent. The Net Promoter Score, NPS, is a management tool that asks one simple question. On a scale of 0 to 10, how likely are you to recommend this product or company to a friend or colleague? Those who answer 9 or 10 are promoters. Those who answer 7 or 8 are passives, and those from 0 to 6 are detractors. A great company has a vast number of promoters. You may not have access to a company's internal NPS data, but you can create your own. Scour the internet. Go to Reddit threads, YouTube comment sections, and product review sites. Is the overwhelming sentiment one of enthusiastic recommendation? Are customers actively telling others they must try this product? This is the volunteer sales force in action. Look for the language they use. Phrases like, "It changed my life," "I tell everyone about it," or "You have to get one," are clear signals of a promoter. Step 3 is to assess community engagement. Great brands are not just sold, they are discussed. There is a vibrant ecosystem of conversation around them. Your job is to find it and gauge its health. Does the company have a dedicated subreddit? How many members does it have, and how active are they? Are there independent YouTube channels, blogs, or podcasts dedicated to the brand and its products? This is a critical indicator. When customers are creating their own content about a brand, for free, it shows a level of engagement that goes far beyond simple satisfaction. They are co-creating the brand's culture. This is a sign of an incredibly strong in-group and a very wide moat. Step 4 of the brand loyalty audit is to test for brand resilience. How does the brand and its community react to negative news or a product flaw? A weak brand will see customers flee at the first sign of trouble. A fanatically loyal customer base will do the opposite. They will defend the brand. They will rationalize the mistake, offer forgiveness, and attack the critics. When Apple had issues with AntennaGate on the iPhone 4, the loyal user base largely shrugged it off, or, in some cases, defended the company's design choices. This kind of resilience is a powerful asset. It allows a company to make mistakes and recover, while a less loved competitor might be permanently damaged by a similar event. Search for past controversies or product failures. How did the stock price react? More importantly, how did the customer base react? Their reaction will tell you everything you need to know about the strength of their loyalty. By running a company through this 4-step audit, repeat purchases, promoter score, community engagement, and brand resilience, you build a mosaic of its intangible moat. This is the deep, qualitative analysis that most retail investors never bother to do. It's the work that allows you to see the fortress that Buffett saw in a simple box of chocolates, giving you an enormous edge in your stock picking and your quest for market-beating capital gains. The vast majority of investors, the 99%, take the exact opposite approach. They fall into what we can call the spreadsheet trap. Their entire process of stock analysis is confined to the quantifiable. They build complex discounted cash flow models, scrutinize price-to-earnings ratios, and debate the minutiae of debt-to-equity figures. They believe that if they can just master the numbers, they can predict the future. This approach feels safe, logical, and rigorous. But it is dangerously incomplete. It's like trying to understand a human being by only looking at their blood test results. You get some data, but you miss their personality, their relationships, their passions, the very things that often determine their success in life. The spreadsheet trap leads investors to systematically undervalue the most durable form of competitive advantage, the emotional bond between a company and its customers. A classic example of this folly can be seen in the historical analysis of companies like Kodak versus Fuji. For decades, Kodak was a titan of industry. Its financials were impeccable, its market share was dominant, and its name was synonymous with photography. An investor looking solely at the spreadsheets in the 1980s would have concluded it was an unassailable fortress, a perfect long-term investing vehicle. However, they would have missed the subtle shift in consumer behavior. Kodak's moat was built on a complex chemical process that was difficult to replicate. But their relationship with the customer was transactional. People bought Kodak film because it was the reliable default choice. There was respect, but there wasn't love. Fuji, on the other hand, particularly in its home market of Japan, cultivated a deeper connection with photographers, often catering to professionals and enthusiasts who were passionate about the unique color science of their films. When the digital revolution arrived, it was a tidal wave that threatened both companies. Kodak, the spreadsheet darling, made a series of disastrous executive decisions. They were so focused on protecting their existing cash cow film sales that they fumbled the transition to digital, a technology they themselves had invented. Their transactional customer base felt no loyalty. When a better, more convenient digital option came along from Sony or Canon, customers switched without a second thought. There was no tribe to defend the Kodak brand. They were just customers, and they went where the value was. The company, once a blue-chip stalwart, spiraled into bankruptcy. The path of the 99% is to look at a company like Kodak in its heyday and see only its historical financial strength. They mistake a temporary technological advantage for a permanent moat. They fail to perform the brand loyalty audit. They don't ask, do customers love this brand? Would they defend it? Is there a community around it? They see numbers, not people. This mistake is repeated endlessly. Investors buy cheap retail stocks based on low price-to-book ratios, ignoring the fact that the stores are empty and the brand has become irrelevant to a new generation of shoppers. They invest in technology companies with impressive-looking user growth numbers, failing to realize that the users are mercenaries, ready to jump to the next hot platform for a slightly better feature. The antithesis of the Buffett approach is to believe that the past, as recorded in financial statements, is a reliable guide to the future. Buffett, Munger, and those who follow their philosophy understand that financials are a rear-view mirror. They tell you where a company has been. But the fanatical loyalty of customers, the intangible moat, that is a forward-looking indicator. It's the engine that will generate the financials of the future. The 99% are driving by looking in the rearview mirror. The successful investor is looking out the front windshield, spotting the signals of customer love that predict the open road ahead. The connection between this intangible moat of customer loyalty and a company's financial statements is not theoretical. It is direct, quantifiable, and profound. Mastering the ability to see this qualitative factor allows you to predict future financial performance long before it becomes obvious to the spreadsheet-bound analyst. Let's trace the journey from a customer's love to the hard numbers that drive capital gains. The first and most immediate impact is on the top line of the income statement: revenue. This impact is twofold. First, as we saw with the brand loyalty audit, fanatically loyal customers exhibit high repeat purchase behavior. This creates a stable, recurring revenue base that is far more predictable and valuable than revenue generated from one-off sales. Predictable revenue is a hallmark of a high-quality business, and the market rewards this predictability with a higher valuation multiple. Second, and more importantly, is the effect on customer lifetime value (LTV). LTV is a measure of the total profit a company can expect to make from a single customer over the entire course of their relationship. A loyal customer who buys from you for 30 years is exponentially more valuable than a customer who buys once and leaves. When you see a brand with a tribe of followers, you are seeing a company with an extraordinarily high LTV. Now compare this to the cost of acquiring that revenue. The customer acquisition cost, CAC, is what a company spends on marketing and sales to get a new customer. For most businesses, this is a huge and perpetual expense. But for a company with a beloved brand, the CAC is drastically lower. Their best customers are their marketing department, working for free. This creates a magical financial dynamic. The ratio of LTV to CAC is one of the most critical metrics for a growing business. A healthy business might have an LTV that is 3 times its CAC. A legendary business, one with a powerful intangible moat, can have a ratio of 10, 20, or even higher. This financial advantage flows directly to the company's margins. When you acquire customers for free through word of mouth, you don't have to spend as much on advertising. This lower spending on sales and marketing as a percentage of revenue means higher operating margins. Higher operating margins mean more profit falls to the bottom line than net income. This is the engine of wealth creation. Let's consider 2 companies. Company A has to spend 30% of its revenue on marketing to grow. Company B, with its fanatical customer base, only has to spend 5%. If both companies have the same gross margin of 60%, Company A's operating margin will be 30%. While Company B's will be a whopping 55%. That extra 25% margin is pure profit, generated directly from the intangible asset of brand loyalty. It allows Company B to invest more in research and development, to buy back shares or to pay dividends, all of which drive long-term shareholder value. Furthermore, this moat strengthens the balance sheet. The consistent cash flow generated by a loyal customer base makes the business less reliant on debt to fund its operations or growth. A stronger balance sheet with less debt makes the company more resilient during economic downturns, a key principle for any investor focused on wealth management. The ultimate financial manifestation of the intangible moat is superior return on invested capital, ROIC. ROIC measures how efficiently a company is using its capital to generate profits. Because a business with a powerful brand doesn't need to tie up huge amounts of capital in factories to compete on price. or in a massive sales force to push its product, it can generate enormous profits from a very small capital base. See's Candies is the ultimate example. After the initial purchase price, it has required very little new capital, yet it has gushed cash for 50 years. Its ROIC is almost infinite. This is the financial holy grail that Buffett is always searching for. By training yourself to spot the qualitative signs of a beloved brand, you are essentially developing a leading indicator for identifying companies with a favorable LTV/CAC ratio, expanding operating margins, and exceptionally high returns on invested capital. You are seeing the cause long before the rest of the market sees the effect in the quarterly earnings report. That is the information edge that leads to life-changing returns. The second fundamental pillar of this thesis goes beyond defense. It's about offense. It's the realization that fanatical customers don't just protect the business with a moat, they actively expand its borders. They become a zero-cost growth engine, a volunteer army of evangelists who drive customer acquisition at a marginal cost that approaches zero. This is one of the most powerful and misunderstood forces in business, and Warren Buffett's understanding of it was shaped by his single greatest investment, Coca-Cola. The story begins in 1988. The market was still reeling from the Black Monday crash of October 1987. Fear was rampant. Investors were dumping stocks, convinced that the good times were over. Buffett, as is his habit, was doing the opposite. He was hunting for bargains, looking for wonderful companies that had been put on sale by the market's panic. He turned his attention to the Coca-Cola Company. For years he had admired the business from afar. He was a personal consumer, famously drinking at least 5 Cokes a day. He had observed its power firsthand, but it was only in 1988 that he did a deep dive into the business and its history, and what he found was not just a beverage company, but a masterclass in creating a zero-cost growth engine. He traced the company's history back to its origins. He saw how Coca-Cola had spread from a single soda fountain in Atlanta to literally every corner of the globe. A significant part of this expansion wasn't driven by a massive, centrally planned advertising budget, at least not in the early days. It was driven by human connection and storytelling. Soldiers in World War II became ambassadors for the drink, introducing it to locals in Europe and Asia. The iconic curved bottle became a symbol of American optimism and culture, a story in itself. People didn't just drink Coke, they shared it. The act of sharing a Coke became a universal gesture of friendship. The company's own advertising, like the famous "I'd like to buy the world a Coke" campaign, wasn't just selling a product. It was reinforcing a story that customers were already telling each other. It was providing the soundtrack for the evangelism that was already happening organically. Buffett saw that every single time a person chose a Coke over water or another beverage, a tiny economic miracle occurred. The company was tapping into a pre-existing habit, a sliver of mindshare that was incredibly difficult for any competitor to dislodge. But the true genius was how the company had engineered a system where its customers did the marketing. When you host a party, you buy a case of Coke. When you go to a restaurant, you order a Coke by name. You are, in that moment, an unpaid salesperson for the company. You are introducing the product to friends, reinforcing its social acceptability, and perpetuating its dominance. Buffett realized that this global army of casual evangelists was an asset of incalculable value. A competitor could spend billions of dollars on advertising, they could try to replicate the taste, they could undercut the price, but they could never replicate the century of shared memories, habits, and stories that made Coke the default choice in billions of human interactions every single day. He looked at the financials and saw the result of this engine. The company required very little capital to grow. It wasn't building massive, expensive factories itself. It was primarily selling syrup to a network of bottlers. Its main asset was the brand, the story, the space it occupied in the minds of billions of people. This allowed it to generate incredible returns on capital. So in the midst of market chaos, Buffett began buying. Between 1988 and 1989, Berkshire Hathaway invested over $1 billion to acquire a stake of around 7% of the company. It was a massive bet, one of the largest he had ever made. His peers were stunned. They saw a mature, slow-growing company and wondered why the great value investor was paying a premium for it. They were looking at the spreadsheet. Buffett was looking at the behavior. He saw the zero-cost growth engine. He knew that this engine would continue to drive sales, expand margins, and gush cash for decades to come. The investment became a cornerstone of Berkshire's portfolio, a testament to the power of a brand that has turned its customers into a global, volunteer sales force. The phenomenon of customers transforming into a volunteer sales force is not an accident. It is the result of a company successfully tapping into powerful psychological drivers, primarily the reciprocity principle and the power of a compelling narrative. When a business delivers an experience that is overwhelmingly positive, surprising, or delightful, it triggers a deep-seated human instinct, the principle of reciprocity. This principle, identified by psychologist Robert Cialdini, states that we feel a sense of obligation to give back to others who have first given to us. This is a fundamental social glue that allows societies to function. When someone does you a favor, you feel an unconscious urge to do a favor in return. Great businesses weaponize this. They create a product or service so good that the customer feels almost indebted. The value they receive so far exceeds the price they paid that they feel a genuine desire to reciprocate. But how can they pay back a large corporation? They can't send a thank you card to the CEO, so they pay the company back in the most valuable way possible. They tell other people. They provide a glowing recommendation. This is not a calculated decision. It's a gut-level emotional response to an overwhelmingly positive experience. Think about the last time a company truly wowed you. Maybe a hotel upgraded you to a suite for free. Maybe a customer service agent spent an hour on the phone patiently solving your problem. Maybe a product worked so flawlessly and intuitively that it brought a moment of joy to your day. What was your first instinct? It was likely to share that story. You told your partner, you texted a friend, you posted it on social media. You were repaying the company's gift of a great experience with the gift of your personal endorsement. This act of reciprocation is the spark that ignites the zero-cost growth engine. For an investor searching for clues of this engine, the key is to look for evidence of customer delight. Scour reviews and forums for words like love, amazing, best ever, and life-changing. This is the language of reciprocity. Mere satisfaction doesn't create evangelists. Satisfaction is getting what you paid for. Delight is getting far more than you expected. It's the delight that creates the feeling of indebtedness that fuels word-of-mouth marketing. However, reciprocity alone is not enough. For word-of-mouth to be effective, it needs a vehicle. That vehicle is a story. Humans are wired for narrative. We don't communicate in data points and feature lists. We communicate in stories. A brand that wants to turn its customers into evangelists must give them a good story to tell. Coca-Cola's story was about happiness, sharing, and global unity. The story wasn't just in their ads. It was baked into the experience of the product itself. The early stories of Apple were about rebellion, creativity, and challenging the status quo. The story of Tesla is about innovation, the future, and saving the planet. These are simple, powerful, and easily repeatable narratives. When a customer tells a friend why they love their Tesla, they don't just list the car's acceleration specs. They tell a story about the future of driving, about being part of a movement, about the experience of the technology. The company has armed them with a compelling narrative that they are eager to share. A key part of your qualitative analysis as a retail investor or entrepreneur should be to ask, what is this company's story? Is it simple? Is it emotional? Is it something a customer would be proud to repeat? If a company's story is just, we offer good value, or our product has these 10 features, it will never create a volunteer sales force. Those are not stories, they are claims. A story has a hero, the customer, a challenge, and a resolution made possible by the brand. When a company gets this right, its customers don't feel like they are marketing a product. They feel like they are sharing a powerful and personal story. They become the heroes of their own narrative, and the brand is their magical tool. This combination of creating genuine delight to trigger reciprocity and providing a compelling narrative to carry the message is the psychological one-two punch that turns a passive consumer into an active evangelist, creating a growth engine that competitors can neither buy nor silence. How can you, the investor looking for portfolio growth, systematically identify this zero-cost growth engine? You need a practical framework, a mental model for dissecting how a company's product and marketing work together to encourage user-driven growth. We can call this process mapping the evangelism loop. This isn't just about noting that a company has good word of mouth. It's about understanding the specific mechanics of how that word of mouth is generated and spread. The evangelism loop consists of 4 key stages: the trigger, the action, the reward, and the investment. Your job is to analyze a company and see how effectively it moves customers through this loop. Stage 1 is the trigger. This is the moment of delight, the spark of reciprocity we just discussed. What specific event or feature in the customer experience is so exceptional that it makes someone want to talk? For an early Dropbox user, the trigger was the "it just works" magic of a file seamlessly appearing on another device. It felt like a superpower. For a guest at a Ritz-Carlton hotel, it might be an employee going far beyond their job description to solve a personal problem. Your task is to find these triggers. Read the 5-star reviews. What specific things do customers rave about? Is it the unboxing experience? The user interface? The customer support? A company that reliably produces these moments of delight has mastered the first stage of the loop. A business without a clear, repeatable trigger will never generate organic growth. Stage 2 is the action. This is the act of sharing itself. A great company makes this action as easy and frictionless as possible. This is where modern referral programs and social media integration come in. Does the company's app have a share with a friend button that is easy to find and use? Do they provide a unique referral code that gives both the existing customer and the new customer a benefit? This codifies the principle of reciprocity. The company is rewarding the customer for their evangelism. But it goes beyond formal programs. Is the product itself inherently social or visible? A Peloton bike sitting in a living room is a conversation starter. A stylish Allbirds shoe is a walking billboard that invites the question, "Where did you get those?" The best products have the sharing mechanic built right in. Stage 3 is the reward. The customer has taken the action to share. What do they get in return? Sometimes the reward is extrinsic, like a discount on their next purchase or a cash bonus from a referral program. These can be effective, but the most powerful rewards are intrinsic. The primary intrinsic reward is social capital. By recommending a great product, the customer looks smart, savvy, and helpful to their friends. They get the satisfaction of having improved someone else's life. They are seen as a person with good taste. Brands that are aspirational or tied to an identity are masters at providing this intrinsic reward. Recommending a high-end fashion brand or a cutting-edge piece of technology elevates the recommender's own status. Your analysis must ask, what reward, extrinsic or intrinsic, does the evangelist receive? If there is no reward, the loop will break. Stage 4 is the investment. This is the final and most crucial step. After a customer has gone through the loop, they are asked to invest a little bit of time, effort, or data back into the product. This could be by setting up a profile, following friends, or customizing their settings. This small act of investment serves 2 purposes. First, it makes the product more valuable to the user, making them more likely to stick around. Second, it loads the trigger for the next pass through the loop. By adding their contacts to a social network, they are setting up future notifications that will bring them back to the service. By customizing a playlist, they are creating an asset they don't want to lose. This investment increases their psychological switching costs and solidifies their place in the in-group. By mapping these 4 stages, trigger, action, reward, investment, for any given company, You can move beyond a vague sense of good word of mouth to a concrete understanding of their growth mechanics. This tool, a key component of sophisticated qualitative analysis, allows you to differentiate between a company with fleeting buzz and one with a sustainable, compounding, zero-cost growth engine, a distinction that is crucial for long-term investing success and beating the market. The opposite path, the one trodden by the 99% of businesses and the investors who buy them, is the paid acquisition treadmill. This is the reality for companies that have failed to build a product or brand that inspires evangelism. They have no zero-cost growth engine. Their only way to grow is to perpetually spend money on advertising and marketing. They are like a shark that must constantly swim or it will die. This model is incredibly common and for investors incredibly dangerous. A business on the paid acquisition treadmill lives and dies by its marketing budget. To get $1 of revenue, they might have to spend 30, 40, or even 50 cents on Google ads, Facebook ads, television commercials, and a large sales force. In a booming economy when capital is cheap and customers are spending freely, this can look like a viable strategy. The company reports impressive top-line revenue growth, and investors, particularly those who don't look too deeply, get excited. They see growth and they buy the stock. But they are missing the fragility of the entire enterprise. The problem with the treadmill is that it is brutally competitive and the costs are always rising. As more companies flock to platforms like Google and Facebook to acquire customers, the cost per click and cost per impression goes up. The company has to spend more and more money just to stay in the same place. Their LTV/CAC ratio, which we know is critical, starts to compress. The engine of their growth is not their customers' love. It's their venture capital funding or their line of credit. Consider the countless direct-to-consumer brands that have emerged over the past decade. Many of them offer decent products, but they lack a truly exceptional trigger or a compelling story. Their entire business model is based on arbitrage, the ability to acquire a customer through social media ads for less than that customer's lifetime value. For a while this works, but then several things happen. First, competitors emerge, selling a similar product and bidding on the same keywords, driving up ad costs. Second, privacy changes, like Apple's tracking transparency updates, make it harder and more expensive to target ads effectively. Suddenly, their acquisition costs skyrocket. The treadmill speeds up. The company must now spend more for each customer, and their profit margins evaporate. They are forced to raise prices, which can alienate their non-loyal customer base, or cut back on marketing, which causes their growth to slam to a halt. This is a precarious and exhausting way to run a business. From an investment perspective, these companies are ticking time bombs. An investor who is only looking at revenue growth is seeing a mirage. They are mistaking expensive, bought growth for cheap, organic growth. This is a classic mistake made by those who don't engage in deep qualitative analysis. They fail to map the evangelism loop. They would quickly discover that for these companies, the loop doesn't exist. There is no trigger of delight, no easy action for sharing, no intrinsic reward. The entire business is a funnel, not a loop. Money goes in the top, and a smaller amount of profit, if any, comes out the bottom. When you are evaluating a potential investment, especially a high-growth company, one of the most important questions you can ask is, what would happen to this business if it had to cut its marketing budget by 90% tomorrow? Would it wither and die? Or would it continue to grow powered by its army of evangelists? A company on the paid acquisition treadmill would collapse. A company with a true zero-cost growth engine, a company like Coca-Cola in its prime, would barely notice. Understanding this distinction is fundamental to avoiding the value traps that ensnare the 99% of investors and is a vital step for any entrepreneur aiming to build a truly durable enterprise. The financial consequences of possessing a zero-cost growth engine are not just significant, they are transformative. This qualitative advantage creates a cascade of positive effects on a company's financial statements. leading directly to the kind of explosive capital gains that define market-beating investments. The key concept to understand here is operating leverage. Operating leverage is the degree to which a company can increase its operating income by increasing revenue. A business with high operating leverage sees its profits grow much faster than its sales. And a zero-cost growth engine is the ultimate source of high operating leverage. Let's create a simplified scenario. Imagine two software companies, Treadmill Tech and Evangelist Enterprises. Both have a great product and currently have $100 million in revenue. Both also have a cost of revenue of $20 million, leaving them with $80 million in gross profit. Now, let's look at their operating expenses. Treadmill Tech has no organic growth. To get its next $50 million in revenue, it has to spend a fortune on sales and marketing. Let's say its sales and marketing expense is 40% of revenue, or $40 million. Evangelist Enterprises, on the other hand, grows almost entirely through word of mouth. Its sales and marketing expense is only 5% of revenue, or $5 million. Let's assume both have another $20 million in R&D and G&A expenses. At $100 million in revenue, Treadmill Tech's operating income is $80 million, gross profit $40 million, S&M $20 million, other equals $20 million. Evangelist Enterprises operating income is $80 million, $5 million, $20 million, equals $55 million. A huge difference already. But now, let's see what happens when both companies grow their revenue by 50% to $150 million. Their gross profit also grows by 50% to $120 million. Treadmill Tech, to achieve this growth, has to scale its marketing spend. 40% of $150 million is $60 million. Its operating income is now $120 million. $60 million. $20 million equals $40 million. Its revenue grew 50%, and its profit grew 100%. That's decent operating leverage. But look at Evangelist Enterprises. Because its growth is organic, its marketing spend barely needs to increase. Let's say it goes up slightly to $7 million. Its operating income is now $120 million. $7 million, $20 million equals $93 million. Its revenue grew 50%, but its profit grew by nearly 170%. This is the explosive power of a zero-cost growth engine. As revenue scales, the costs associated with acquiring that revenue do not. The incremental profit margin on each new customer is massive. This waterfall of profit does incredible things for shareholder value. It generates enormous amounts of free cash flow, the cash left over after all expenses and investments. This free cash flow is the lifeblood of a business and the ultimate driver of its stock price. A company gushing free cash flow can do several things to reward shareholders. It can reinvest that cash into new products or markets, further accelerating its growth. It can pay out a growing dividend, providing a direct return to investors. Or it can buy back its own shares. Share buybacks are a particularly powerful tool. When a company reduces its number of shares outstanding, each remaining share represents a larger ownership stake in the business, which should lead to a higher share price. The ability to fund massive buybacks from internally generated cash, rather than debt, is a hallmark of a truly elite business. For the investor conducting stock analysis, the presence of a zero-cost growth engine should be a massive green flag. It is a leading indicator of future margin expansion, soaring free cash flow, and aggressive capital return programs. You are identifying a business that is not just growing, but is growing more profitably with each passing quarter. This is how you find the multi-baggers, the stocks that don't just beat the market but can single-handedly transform your portfolio. You find them by looking for the qualitative evidence of evangelism, knowing that this is the cause that will soon produce the stunning financial effects everyone else will be late to notice. The third pillar in understanding the power of customer fanaticism is perhaps the single most important metric in Warren Buffett's entire investing framework: pricing power. Pricing power is a company's ability to raise its prices without losing significant business to a competitor. It is, in Buffett's own words, the single most important decision in evaluating a business. If you have the power to raise prices without losing business to a competitor, you have a very good business. And if you have to have a prayer session before raising the price by 10%, then you have a terrible business. The ultimate source of durable pricing power is a fanatically loyal customer base. The foundational anecdote for this lesson is one of survival and dominance, the story of American Express and the salad oil scandal. The year was 1963. American Express was a respected company, primarily known for its travelers' checks and a burgeoning charge card business. A significant but less glamorous part of their business was in warehousing. Through a subsidiary, they would inspect a company's inventory and then issue receipts for it. Other banks would then lend money to the company, with the inventory, as certified by Amex, serving as collateral. One of their biggest clients was the Allied Crude Vegetable Oil Refining Corporation, run by a charismatic fraudster named Tino DeAngelis. DeAngelis had a simple but brilliant scam. His massive storage tanks in New Jersey were mostly filled with seawater. Only a thin layer of valuable salad oil floated on top. When American Express inspectors would dip their rulers in to measure the inventory, everything seemed fine. DeAngelis used the fraudulent warehouse receipts from American Express to secure over $150 million in loans, a colossal sum at the time. In November 1963, the music stopped. The fraud was exposed, DeAngelis's company collapsed, and the banks who had lent the money came looking for their collateral. When they found the tanks were full of water, they turned to the company that had certified the inventory, American Express. Legally, American Express's liability was limited. The subsidiary was a separate entity. The parent company could have walked away, declared the subsidiary bankrupt, and saved its own skin. This is what most corporations would have done. The financial impact would be contained. But the new CEO of American Express, Howard Clark, and a key board member and major shareholder, Warren Buffett's future partner, Charlie Munger, understood something deeper. They knew that the value of American Express was not in its physical assets. It was in two words printed on their products: American Express. Those words represented absolute trust and integrity. If they were to hide behind legal technicalities, that trust would be shattered. The brand would be permanently tarnished. Clark made a courageous and, at the time, highly controversial decision. He announced that American Express would, as a matter of honor, make good on all the fraudulent receipts. They would cover the entire $150 million in losses, a figure that threatened to wipe out the company's entire net worth. Wall Street panicked. The stock plummeted by over 50%. Investors saw only the massive, immediate financial loss. They believed the company was finished. But Buffett, observing from the sidelines, saw something else entirely. He saw an act of immense long-term wisdom. He started doing his scuttlebutt research. He went to banks, restaurants, and travel agencies. He asked them a simple question: "Are you still accepting American Express cards and traveler's checks?" The answer was a resounding yes. He then asked their customers if the scandal had made them stop using their Amex cards. The answer was no. In fact, the opposite was happening. The company's brave and honorable response was actually strengthening its brand. Customers and merchants felt that this was a company you could truly trust, a company that would stand behind its word no matter the cost. The scandal, which should have destroyed them, became their finest hour. Buffett realized that American Express's customer base was so loyal, and its brand was so associated with quality and security, that it had immense pricing power. Customers were willing to pay an annual fee for their charge card, and merchants were willing to pay a higher discount rate than for other cards, because the association with the American Express brand brought them more affluent and loyal customers. The company wasn't just surviving, it was poised to thrive. He invested heavily, and the bet paid off spectacularly. The salad oil scandal taught him that a business with true pricing power, rooted in the trust and loyalty of its customers, can weather almost any storm. More importantly, it can consistently raise prices year after year, turning a small increase in revenue into a massive increase in pure profit. This ability became his holy grail in his search for the world's greatest businesses. The reason pricing power is so potent is because it short-circuits some of the most powerful and often irrational psychological biases that govern consumer behavior. A company that has cultivated fanatical loyalty can raise prices with confidence because it knows its customers are not making decisions based on pure logic. They are driven by forces like the endowment effect and the need to avoid cognitive dissonance. The endowment effect is a well-documented bias where we overvalue things that we own. In a famous experiment, participants were given a coffee mug and then asked how much they would sell it for. Another group, who were not given a mug, were asked how much they would pay for one. Consistently, the owners of the mug demanded a much higher price to sell it than the non-owners were willing to pay. The mere act of ownership imbued the object with extra value. Beloved brands tap into this effect masterfully. Once a customer has integrated a product into their life, it becomes part of their personal endowment. It's not just a smartphone, it's my iPhone. It's not just a pair of sneakers, it's my Nikes. This sense of ownership makes the customer less price-sensitive. When the company raises the price, the customer isn't evaluating the new price against a competitor's product from a neutral standpoint. They are evaluating it against the pain of losing something that is already theirs. Because of the endowment effect, the pain of losing their familiar product feels much greater than the potential gain of saving a few dollars on a new, unfamiliar one. This is why people will pay a premium for the new version of a product they already own and love, even if a competing product is objectively better on some metrics. The switching cost isn't financial. It's the emotional cost of giving up part of their endowed property. The second related principle is cognitive dissonance. This is the mental discomfort we feel when we hold two conflicting beliefs, or when our actions contradict our beliefs. We are strongly motivated to reduce this discomfort. When it comes to purchasing decisions, cognitive dissonance is a powerful force for loyalty. Imagine a customer who has spent years evangelizing a particular brand of car. They've told all their friends it's the best, most reliable, most innovative car on the road. They have defended this choice, making it part of their identity. Now, the company raises the price of its new model. To reject the new model because of the price would create massive cognitive dissonance. It would be an admission that their past beliefs and advocacy were wrong. It would mean confronting the possibility that they are no longer part of the in-group. To avoid this mental pain, the customer is highly motivated to find reasons to justify the price increase. They will tell themselves, well, the quality is worth it, or they've added new features that justify the cost, or it's still the best and I believe in supporting this company. They will actively seek out information that confirms their decision and ignore information that contradicts it. They become an active participant in justifying the company's pricing strategy. This is the psychological magic of pricing power. The company isn't just forcing a price increase on a passive customer. It is leveraging the customer's own psychological need for consistency and self-justification. For an investor, identifying a company that can do this is like finding a hidden superpower. You need to look for signs of this dynamic. Are customers defending price increases online? Do they frame the high price as a sign of quality rather than a ripoff? This is evidence of a customer base that is psychologically locked in, allowing the company to turn small price hikes into a torrent of pure profit, a key ingredient for achieving long-term financial freedom. How can you, as an investor engaged in stock picking, systematically determine if a company has this elusive pricing power? You need a practical mental model, a thought experiment backed by research, to assess this critical factor. We can call this framework the price elasticity test. Price elasticity of demand is an economic concept that measures how much the quantity demanded of a good changes when its price changes. A product with high elasticity is very sensitive to price changes. A small price increase causes a large drop in demand. A product with low elasticity, or is inelastic, is the opposite. The company can raise prices and demand will barely change. Our test is a qualitative way to determine if a company's products are inelastic. The core of the test is a single, powerful question. If this company raised the price of its flagship product by 10% tomorrow, what would happen? To answer this, you need to conduct a multi-step investigation. Step 1 is the gut check and brand identity analysis. Start with your own intuition. Does a 10% price increase seem outrageous or plausible? For a generic brand of milk, a 10% hike would send customers flocking to a competitor. It feels outrageous. For the next iPhone, a 10% hike would be met with grumbling, but most committed users would almost certainly still buy it. It feels plausible. Why? This comes down to the brand's identity. Is the brand a low-cost provider whose entire value proposition is being the cheapest? If so, it has zero pricing power. Or is its value proposition based on quality, status, convenience, or identity? Brands built on these pillars are the ones with pricing power. Analyze the company's marketing. Is it all about price, or is it about a lifestyle, a feeling, a technical superiority? Step 2 is the historical price analysis. Look back at the company's history. Have they successfully raised prices in the past? Go through old press releases, news articles, and investor presentations. How often have they implemented price increases? When they did, what was the impact on their sales volume and revenue in the following quarters? Did revenue go up by the amount of the price increase or more? This indicates they didn't lose customers. Or did revenue go up by less, or even fall, indicating a loss of volume? A history of successful, regular price increases is the strongest possible evidence of pricing power. Step 3 is the customer outrage sentiment analysis. This is where you put your ear to the ground. Find online forums, Reddit threads, and social media discussions where customers talk about the brand's prices. What is the tone? Is it constant complaint about being ripped off? Or is there a sense of resignation or even justification? In communities around brands like Apple or Tesla, you'll often see fans defending the high prices to critics. They'll say, "You get what you pay for," or "It's an investment in quality." This is a goldmine for an investor. It's direct evidence that the customer base is not making decisions on price alone and is psychologically primed to accept future increases. Search for phrases like brand name price increase and see what the reaction was. Step 4 is the competitive landscape analysis. Pricing power is always relative to the alternatives. How easy is it for a customer to switch to a competitor? Are the switching costs high or low? Switching costs aren't just financial. They can be procedural, the effort of learning a new system, or, as we've discussed, psychological, the pain of leaving your tribe. A company whose product is deeply integrated into a customer's life or workflow has high switching costs and, therefore, more pricing power. Can you easily export your data? Is the competitor's product compatible with your existing setup? If the answer is no, the company has a captive audience and can raise prices with less fear of defection. By running a company through this 4-step price elasticity test, you create a robust, evidence-based thesis on its pricing power. This isn't a guess. It's a piece of investigative financial journalism. This is the kind of deep, qualitative analysis that separates the amateur retail investor from the professional. It allows you to identify businesses that have a direct, almost mechanical, lever to pull to increase their profitability, a crucial insight for beating the market and building lasting wealth. The antithesis to seeking out businesses with pricing power is the all-too-common strategy of investing in companies caught in a race to the bottom. These are businesses that operate in highly commoditized industries where the product or service is largely undifferentiated from its competitors. In this environment, the only meaningful lever a company has to compete is price. This creates a brutal, margin-crushing dynamic that is toxic for long-term capital gains. A commodity business is one where the customer perceives little to no difference between providers. Think of industries like basic agricultural products, shipping, or even certain segments of consumer electronics or air travel. When a customer is buying a sack of wheat, a seat on a flight from New York to Chicago, or a generic USB cable, their primary decision driver is price. They will almost always choose the cheapest available option that meets their basic needs. Companies in these industries are on a perpetual treadmill of cost-cutting. Their entire focus is on making their operations 1 penny cheaper than the next guy's, so they can offer a slightly lower price and win the sale. This is a terrible position to be in. Any competitive advantage gained through efficiency is usually temporary. A competitor will soon copy the innovation or find another way to cut costs, and the price war resumes. This race to the bottom has disastrous financial consequences. Profit margins are razor-thin and constantly under pressure. The companies are often highly cyclical, earning decent profits when demand is strong and supply is tight, but then suffering brutal losses when the cycle turns. They require huge amounts of capital to stay competitive, building more efficient factories, buying newer, more fuel-efficient airplanes, but the returns on that capital are meager and unreliable. For the investor who is seduced by the apparent cheapness of these stocks, this is a dangerous trap. They might look at a commodity airline stock and see a low price-to-earnings ratio during a good year. They think they found a bargain, but they are failing to recognize the fundamental weakness of the business model. They are ignoring Buffett's prayer session test. That airline CEO knows that if they raise ticket prices by 10% across the board, their planes will fly empty as customers flock to a cheaper competitor. They have zero pricing power. Consider the fate of countless generic PC manufacturers in the 1990s and 2000s. They were all assembling computers from the same set of components: Intel chips, Microsoft Windows. There was no brand loyalty, no unique user experience. The only way to compete was on price. This led to a bloodbath. Margins collapsed. And one by one, companies like Gateway E-Machines and Packard Bell either went bankrupt or were acquired for pennies on the dollar. An investor who focused only on their high revenue growth or seemingly low PE ratios was wiped out. They missed the most important qualitative factor. The customer had no reason to be loyal. They were buying a box, not a brand. The path of the 99% is to be attracted to the complexity and perceived value in these cutthroat industries. They mistake intense competition for a sign of a vibrant market. But the Buffett-monger approach teaches us that the best businesses are the ones that can sidestep competition altogether. They have built a brand so strong, a customer relationship so deep, that they operate in a market of their own. They don't have to participate in the race to the bottom because their customers are not buying on price. They are buying a promise, an identity, a feeling of trust. Avoiding the siren song of commoditized businesses and focusing only on those with demonstrable pricing power is one of the most important disciplines for any investor serious about wealth management and long-term portfolio growth. The financial connection between pricing power and shareholder returns is the most direct and powerful in all of finance. A small increase in price can have an explosive impact on net income, because that increase flows almost entirely to the bottom line. This is not a gradual effect. It is a mathematical certainty that creates enormous value for shareholders. Let's break down the numbers. Imagine a company, Brand Power Inc., with the following simplified income statement: revenue of $100 million, cost of goods sold COGS of $60 million. This gives them a gross profit of $40 million. They have operating expenses like R&D, sales and marketing, and admin of $20 million. This leaves them with an operating income of $20 million. Now, let's say the management of Brand Power Inc. has done their homework. They have passed the price elasticity test with flying colors. They know their loyal customer base will tolerate a price increase. So they decide to raise prices across the board by a modest 5%. Assuming they lose 0 customers, a reasonable assumption for a business with true pricing power, their revenue now jumps to $105 million. Here is the magic. What happens to their costs? Their cost of goods sold, the direct cost of producing their product, remains the same at $60 million. They are selling the same number of units, just at a higher price. Their operating expenses also remain the same at $20 million. They don't need to spend more on R&D or marketing to justify this price increase to their loyal customers. So what does the new income statement look like? Revenue is $105 million. COGS is $60 million. Gross profit is now $45 million. Operating expenses are $20 million. And the new operating income is $25 million. Think about that. A mere 5% increase in price, a 5% increase in revenue, has led to a 25% increase in operating income. The leverage is immense. That extra $5 million in revenue wasn't partially consumed by higher costs. It was pure, unadulterated profit that dropped directly to the bottom line. This is the financial rocket fuel that Buffett is always looking for. This torrent of additional profit has a dramatic effect on the company's valuation. The market values companies based on a multiple of their earnings or cash flow. Let's say Brand Power Inc. was trading at a multiple of 20 times its operating income. Before the price increase, its market capitalization would be 20 times $20 million, or $400 million. After the price increase, its market cap would be 20 times $25 million, or $500 million. That single 5% price increase created $100 million in shareholder value overnight. This is the direct, quantifiable result of the intangible asset of customer loyalty. Furthermore, this pricing power is often a recurring gift. A company with a strong brand can often implement small, regular price increases every year or two. Each time they do this, they unleash another wave of high-leverage profit growth. This is how companies compound their earnings at high rates for decades, leading to the spectacular capital gains that make long-term investing so powerful. When you as an investor are doing your stock analysis, this should be a primary focus. Don't just project revenue growth. Ask where that growth is coming from. Is it from selling more units, which involves more cost, or is it from raising prices, which is almost pure profit? A business that can consistently grow through price is fundamentally superior to one that can only grow through volume. By learning to identify the qualitative signs of a brand that commands this power, you are learning to spot the companies that have a hidden lever to create shareholder value, a lever that the rest of the market often overlooks until the stunning results are already printed in the earnings report. The fourth pillar is the resilience factor. Fanatically loyal customers don't just provide a moat for defense and an engine for growth, they also act as a powerful shock absorber. They provide a degree of resilience that allows a great business to weather economic storms, public relations crises, and competitive onslaughts that would cripple or destroy a lesser company. A business built on transactional relationships is fragile. A business built on emotional connection is durable. The foundational anecdote for this principle is Buffett's legendary investment in the Washington Post Company during one of the most turbulent periods in American history. The year was 1973. The country was in turmoil. The Watergate scandal, which would ultimately bring down President Richard Nixon, was unfolding, and the Washington Post, led by its courageous publisher Katharine Graham and its tenacious reporters Bob Woodward and Carl Bernstein, was at the center of the storm. The Nixon administration was waging an all-out war against the newspaper. They threatened to revoke the company's valuable television broadcast licenses, which were a huge source of its profits. The political and legal pressure was immense. On top of this, the stock market was in the midst of a brutal bear market, and newspaper stocks, in particular, were seen as obsolete, a dying industry. The Washington Post's stock price collapsed, falling by nearly 50%. The market saw a company in a declining industry under direct attack from the most powerful man in the world. It saw immense risk and uncertainty. But Warren Buffett saw something entirely different. He saw a brand with an unbreakable bond of trust with its readers. The Washington Post wasn't just a newspaper. It was a public institution. For its readers in the nation's capital and across the country, it was the definitive source of credible, essential information. The more the administration attacked the paper, the more its readers rallied around it. They saw the Post as their champion, the defender of truth against the corrupting influence of power. This credibility, this fanatical loyalty from its readership, was an intangible asset of immense value. It was the ultimate source of its resilience. Buffett understood that the political threats, while scary, were likely temporary. The power of the presidency would eventually wane, but the trust in the Washington Post brand would endure and even strengthen through the ordeal. He also saw that the market was wrong about the newspaper business, or at least about this newspaper business. While many papers were struggling, the Post had a dominant, near-monopolistic position in a wealthy and influential city. This dominance, secured by its brand loyalty, gave it tremendous pricing power with both its readers and its advertisers. So while other investors were fleeing in terror, Buffett quietly started buying shares. He invested nearly $11 million, accumulating a large stake at a bargain price. He saw beyond the short-term noise and focused on the long-term, durable asset, the trust of the customer. His bet paid off more handsomely than he could have imagined. The Washington Post not only survived the Watergate crisis, but emerged with its reputation enhanced globally. Katharine Graham became an icon of corporate courage. The company's broadcast licenses were never revoked, and the business, powered by its dominant brand, continued to generate enormous profits for decades. That initial $11 million investment would eventually be worth over $1 billion, becoming one of the most successful investments of his career. The Washington Post story is the ultimate lesson in the resilience factor. It teaches us that when a company's relationship with its customers is based on a deep emotional foundation like trust or identity, it can withstand almost any external shock. The loyalty of the customer becomes a shield that protects the business from the inevitable storms of the market and the world. A critical insight for any investor focused on long-term wealth management. The resilience endowed upon a company by its loyal customers is a direct result of powerful psychological principles that insulate it from negative information. The two most prominent are the halo effect and the affect heuristic. These cognitive shortcuts explain why we are so willing to forgive the brands we love and so quick to condemn the ones we don't. The halo effect is a type of cognitive bias where our overall impression of a person, brand, or institution influences our feelings and thoughts about its specific traits. If we have a generally positive impression of a company, we are more likely to judge its actions and products favorably, even in the face of contrary evidence. For example, if a company known for its excellent customer service and high-quality products releases a new product that has a few flaws, its loyal customers are likely to be forgiving. They will interpret the flaws as a temporary slip-up, an anomaly from an otherwise great company. Their positive overall impression, the halo, colors their perception of the specific negative event. They might say, "This is unusual for them, I'm sure they'll fix it quickly." Conversely, if a company with a poor reputation releases a similar product with the same flaws, customers will see it as confirmation of their negative opinion. They'll say, "See? I told you this company makes junk." The objective facts of the product flaw are the same, but the perception is completely different, filtered through the lens of the pre-existing halo. The Washington Post during Watergate is a perfect example. For its loyal readers, the paper had a halo of integrity and journalistic excellence. When the Nixon administration accused the paper of being biased and dishonest, these readers didn't believe it. The accusations bounced off the halo. The readers' default assumption was that the Post was right and the administration was wrong. This psychological shield is an incredibly valuable asset during a crisis. It buys the company time, goodwill, and the benefit of the doubt from its most important constituency, its customers. The second principle, the affect heuristic, is closely related. This is a mental shortcut that allows us to make decisions quickly and efficiently based on our current emotions. If we have positive feelings, a positive affect associated with a brand, we will perceive its actions as having high benefit and low risk. If we have negative feelings, we will perceive the same actions as having low benefit and high risk. Think about a beloved food brand that has a product recall due to a contamination issue. For loyal customers, the positive feelings they have associated with the brand over years of good experiences will likely override their fear. Their affect heuristic will tell them, "I love this brand, it's always been good to me, this must be a rare accident. The risk to me is probably low, and the benefit of continuing to enjoy my favorite food is high." They will be the first ones to start buying the product again once it's back on the shelves. For a less loved generic brand, the same recall can be a death sentence. Customers have no positive emotional bank account to draw from. Their affect heuristic screams, "I don't have any special feeling for this brand, why take the risk? I'll just switch to another one." The risk is perceived as high and the benefit as low. As an investor trying to gauge the resilience of a company, your job is to assess the strength of this positive affect. How do customers talk about the company? Is the language purely transactional, focused on price and features? Or is it emotional, using words like love, trust, and always? The emotional language is a sign of a strong positive affect, which in turn predicts that the company's customers will stick by it through thick and thin. This resilience, born from these psychological biases, is a hidden source of value that allows a company to not just survive crises, but often emerge from them even stronger. To apply this understanding of resilience in your own investment process, you need a structured way to evaluate a company's ability to withstand shocks. You need a mental model we can call the brand stress test. This is a qualitative framework for simulating different crisis scenarios and predicting how a company and its customer base would likely react. It's about moving from a general feeling of a brand's strength to a more rigorous assessment of its durability. The brand stress test has 3 main scenarios you should run. Scenario 1 is the PR crisis. Imagine the company is suddenly hit with a wave of negative publicity. This could be a product safety recall, an executive scandal, or an accusation of unethical behavior. Your task is to predict the fallout. First, consult your findings from the brand loyalty audit. How strong is the in-group? How high is the informal net promoter score? A company with a tribe of evangelists will see those evangelists spring into action, defending the brand on social media and in their personal conversations. This provides a crucial counter-narrative to the negative press. Next, look at the company's history. Has it weathered a crisis before? How did it communicate with its customers? Did it hide and deflect, or was it transparent and accountable, like American Express during the salad oil scandal? A history of handling crises well is a strong indicator of future resilience. A company that passes this part of the stress test is one whose customers would likely give it the benefit of the doubt. Scenario 2 is the new competitor. Imagine a well-funded, aggressive new competitor enters the market tomorrow. They offer a product that is 20% cheaper or has a compelling new feature. Would the company's customer base defect en masse? To answer this, you need to assess the switching costs. Are they high or low? Are they financial, procedural, or psychological? A company like Apple has incredibly high switching costs. A user has their photos, music, and apps locked into the ecosystem. But more importantly, they have their identity as a Mac person. Switching to an Android phone would be a betrayal of their tribe. A company whose customers are locked in by these deep switching costs is highly resilient to new competition. A company whose only advantage is a slightly lower price is incredibly vulnerable. They will fail this stress test. Scenario 3 is the economic downturn. Imagine a severe recession hits, unemployment soars, and consumers tighten their belts. Which products and services will they cut first? And which will they hold on to no matter what? This is a test of a product's perceived necessity. For fanatically loyal customers, certain products move from the category of want to the category of need. That morning coffee from their favorite cafe isn't a luxury. It's an essential part of their daily ritual. Their subscription to a streaming service isn't just entertainment, it's a core part of their lifestyle. These are last-to-be-cut products. You can identify them by looking at customer language. Do they talk about the product as an indulgence or as a necessity? The more a brand has integrated itself into the daily habits and identity of its customers, the more resilient its sales will be during a recession. By subjecting a potential investment to these three simulated scenarios, the PR crisis, the new competitor, and the economic downturn, you can develop a much clearer picture of its resilience. This is a crucial step in separating the fair-weather stocks that look good only in a bull market from the truly durable, all-weather enterprises that can compound your capital for decades. This is the kind of forward-looking risk analysis that is essential for any serious long-term investing strategy. The antithesis of investing in resilient companies is investing in what can be called the fair-weather stock. These are companies that look fantastic during periods of economic expansion and market exuberance, but are built on a foundation of sand. They lack the deep customer loyalty needed to survive when the tide goes out, and they often trap investors who are seduced by their superficial growth. Fair-weather stocks often thrive on novelty and hype. They might be in a hot new industry, with a story that captures the market's imagination. Their revenue growth can be spectacular, driven by a surge of early adopters and media attention. Investors pile in, mesmerized by the rising stock price, assuming that the current trajectory will continue forever. They are caught in the grip of herd bias, buying because everyone else is buying. They failed to conduct a brand stress test because, in the sunny weather of a bull market, it doesn't seem necessary. The problem is that these companies have often not yet built a lasting relationship with their customers. Their users are attracted by the novelty, not bonded by loyalty. They have no halo effect, no deep positive affect. The customer relationship is transactional and shallow. When the first storm hits, the whole structure collapses. A perfect example can be seen in the rise and fall of many fad companies. Think of companies in the diet industry that promote a new, revolutionary weight loss plan. For a time, they can experience explosive growth. The media loves the story, and customers desperate for a solution sign up in droves. The stock soars. But the customers have no real loyalty to the brand itself. They are loyal only to the promise of quick results. When a newer, more exciting fad comes along, they switch instantly. When the company faces criticism that its plan is unhealthy or ineffective, a PR crisis, the customers, feeling no emotional bond, abandon it without a second thought. The fair-weather investor who bought at the peak, looking only at the historical revenue growth, is left holding the bag. Another category of fair-weather stocks is companies that are entirely dependent on a booming economy. For example, a company that sells high-end luxury goods with no strong brand identity. In a good economy, people have discretionary income and are willing to splurge. The company's sales look great, but it fails the economic downturn stress test spectacularly. When a recession hits, these unbranded luxury items are the very first things consumers cut from their budgets. The company's sales plummet, and its stock price collapses. A truly resilient luxury brand, like a Hermes or a Rolex, will see its sales dip in a recession, but its core, loyal customer base will remain. Their products are seen as investments, as status symbols with enduring value. The generic luxury brand has no such protection. The path of the 99% is to chase these fair-weather stocks. It's an exciting but ultimately wealth-destroying game. It's a form of speculation, not investing. It mistakes temporary popularity for durable brand power. It ignores the crucial question of what happens when the weather turns. The disciplined investor, the one focused on wealth management and capital preservation, actively seeks out the opposite. They look for the boring, the predictable, the businesses that have proven, through decades of cycles, that their customers will stick with them, rain or shine. They know that resilience is not an exciting quality, but it is the quality that ultimately builds fortunes. The financial manifestation of the resilience factor is perhaps less explosive than that of pricing power, but it is just as crucial for long-term portfolio growth. Resilience translates directly into lower risk, more predictable earnings, and a more stable stock price, qualities that are essential for compounding wealth over the long term. The most direct financial benefit of resilience is reduced earnings volatility. A company with a fanatically loyal customer base will have a much smoother and more predictable revenue stream than a company with transactional customers. As we saw in the brand stress test, their sales are less susceptible to economic downturns. This stability flows right down the income statement. While the earnings of a cyclical, fair-weather company might swing wildly from large profits to massive losses, the earnings of a resilient company will tend to grow in a much more linear, predictable fashion. Financial markets deeply value predictability. A company with stable, predictable earnings will command a higher valuation multiple, a higher P/E ratio, than a company with volatile, unpredictable earnings. The market is willing to pay a premium for certainty. So the resilience born from customer loyalty not only makes the earnings stream larger over the long run by avoiding catastrophic losses in downturns, but also makes each dollar of those earnings more valuable in the eyes of other investors. This leads to a higher and more stable stock price. During a market crash or correction, all stocks tend to fall, but resilient, high-quality companies tend to fall less than their weaker peers. This is because savvy investors recognize them as safe havens. They know that the business itself is not in jeopardy, and that its earnings will likely recover quickly. This provides a floor for the stock price. The ability to preserve capital during downturns is a massively underrated component of long-term returns. If you lose 50% of your investment, you need a 100% gain just to get back to even. By investing in resilient companies, you minimize those deep drawdowns, allowing your capital to compound more effectively over time. Furthermore, this resilience has a direct impact on a company's balance sheet and its cost of capital. A company with predictable cash flows is seen as a lower credit risk by lenders. This means it can borrow money at a lower interest rate, reducing its interest expense and increasing its net income. This lower cost of capital gives it a significant advantage over its less resilient competitors, allowing it to fund growth and investment more cheaply. For an entrepreneur, this is a critical lesson. Building a brand that inspires fanatical loyalty is not just a marketing strategy, it is a financing strategy. It makes your entire enterprise more robust and financially secure. As an investor performing your stock analysis, when you identify the qualitative signs of resilience, the strong in-group, the positive affect, the high psychological switching costs, you are identifying a business with a lower than average risk profile. You are finding a company that is more likely to survive and thrive through the inevitable uncertainties of the future. This focus on downside protection and earnings stability might not be as thrilling as chasing high-flying growth stocks, but it is the bedrock of the world's most successful wealth management strategies. It is the disciplined path to achieving financial freedom, not through one lucky bet, but through the relentless compounding of high-quality assets. We arrive now at the fifth and final pillar. We have established that fanatical customer loyalty creates an intangible moat, a zero-cost growth engine, immense pricing power, and durable resilience. But all of this is useless if you cannot learn to see it in the real world before everyone else does. The final pillar is the art and science of spotting the signal in the noise. It's about developing the observational skills to identify the next great consumer brand before its power is fully reflected in its financial statements and, consequently, its stock price. This is where you gain your true edge. The foundational anecdote for this skill is perhaps the most surprising of Buffett's modern investments: Apple. For decades, Buffett famously avoided technology stocks. He often said he didn't invest in things he couldn't understand. He shied away from the complex, rapidly changing world of Silicon Valley. So, in 2016, when Berkshire Hathaway's filings revealed it had begun buying a massive position in Apple, the financial world was stunned. Had the Oracle of Omaha finally changed his stripes? Had he tried to become a tech investor in his old age? The answer was a definitive no. Buffett hadn't invested in Apple as a technology company. He invested in it as a consumer products company with the most powerful brand and the most fanatically loyal customers he had ever seen. He didn't need to understand the intricate details of the A11 Bionic chip. He needed to understand consumer behavior, something he had been studying his entire life. His method for analyzing Apple was pure, real-world observation. He talked about going to the mall with his great-grandchildren. He would see which stores they were excited to go into. He saw the crowds in the Apple store. He noticed that people who had an iPhone were incredibly attached to it. They managed their entire lives on this little glass rectangle. He saw the power of the ecosystem, how buying an iPhone led to buying an iPad, a Mac, and Apple services. He didn't see a piece of hardware. He saw a toll bridge into a digital life, a toll bridge that customers were ecstatically happy to pay for. He even conducted his own informal price elasticity test. He would ask people who owned iPhones how much someone would have to pay them to give up their iPhone and never be able to use one again. The numbers people threw out were astronomical. They wouldn't give up their phone and the ecosystem around it for thousands of dollars. Yet the device itself only cost a fraction of that. This revealed to him the enormous, untapped pricing power and the immense consumer surplus the product provided. The value the customer felt they were getting was far greater than the price they were paying. Buffett realized he had made a mistake for years by viewing Apple as a tech company. He started to see it as being much more like See's Candies or Coca-Cola. It wasn't about the technology. It was about the brand's permanent space in the consumer's mind and life. He saw that the iPhone was not a product that people would switch from to save a few $100s. It had become an integral part of their identity. Switching was not just an inconvenience, it was a social and personal disruption. He had finally found a business with a moat as wide as any he had ever seen, an army of evangelists, and near limitless pricing power. He began buying aggressively. Berkshire Hathaway would eventually invest tens of billions of dollars, making Apple its single largest stock holding. The investment has been phenomenally successful, generating over $100 billion in capital gains for Berkshire. The lesson is profound. Buffett didn't use a complex algorithm or insider knowledge to make one of the greatest trades of the 21st century. He used his eyes and his ears. He observed human behavior. He spotted the signal of fanatical loyalty in the noise of everyday life, and had the courage to act on it, even when it seemed to contradict his own past rules. This is the skill that every retail investor can and must cultivate. The ability to spot these signals requires a conscious effort to override our brain's natural tendency to filter out the familiar. To truly see what's happening, we must understand two key psychological principles: confirmation bias and the Baader-Meinhof phenomenon, also known as the frequency illusion. Mastering these is essential for turning everyday observations into actionable investment insights. Confirmation bias is our tendency to search for, interpret, favor, and recall information in a way that confirms or supports our pre-existing beliefs. If you believe a certain stock is a great investment, you will unconsciously pay more attention to positive news about the company and dismiss or downplay negative news. This is incredibly dangerous for an investor because it prevents you from seeing reality objectively. When it comes to spotting customer fanaticism, confirmation bias can cut both ways. If you are already a loyal customer of a brand, you might overestimate the loyalty of others. You might think, "I love this product, so everyone must love it." This can lead you to invest in a company with a niche but passionate following, mistaking it for a company with broad, durable appeal. Conversely, if you personally dislike a brand or don't use its products, you might be blind to the devotion it inspires in others. This was the trap that prevented many traditional value investors from seeing the power of Apple for years. They were PC users who saw the iPhone as an overpriced toy. Their personal bias confirmed their investment thesis, and they missed one of the greatest wealth creation stories in history. To overcome confirmation bias, you must actively seek out disconfirming evidence. If you love a company, your job is to find people who hate it and understand their reasons. If you think a brand is a fad, your job is to find its most passionate evangelists and understand why they are so devoted. This intellectual honesty is the hallmark of a great analyst. The second principle is the Baader-Meinhof phenomenon, or frequency illusion. This occurs after you first learn about or notice something new, and then you suddenly start seeing it everywhere. You buy a new model of car, and suddenly you see that same car all over the road. The cars were always there, but your brain is now primed to notice them. We can intentionally leverage this phenomenon to become better signal spotters. Once you make a conscious decision to look for signs of fanatical loyalty, you will start seeing them everywhere. Your brain's filtering system will be retuned. You'll start noticing which brands people are wearing, which coffee cups they are carrying, which apps they are evangelizing to their friends at dinner. The world becomes a living, breathing source of investment research. The key is to turn this observation from a passive phenomenon into an active process. Don't just notice it. Document it. When you see a long line outside a new restaurant, take a picture. When you hear a friend rave about a new software tool, write it down. When you notice that every person at the park is wearing the same brand of yoga pants, make a note. This process of active observation and documentation turns you from a passive consumer into an active analyst of consumer behavior. It trains your brain to recognize patterns of brand loyalty and evangelism. By understanding confirmation bias, you learn to question your own observations and seek objectivity. By leveraging the frequency illusion, you train your brain to become a highly sensitive detector for the very signals we've been discussing. This combination of psychological awareness and disciplined observation is what allows you to find the next Apple, See's Candies, or Washington Post before the rest of Wall Street catches on. So how do you translate this into a repeatable process? How do you build a system for spotting these signals in the noise of modern life? The answer is to modernize and apply a classic investment technique known as scuttlebutt, a term popularized by the legendary investor Philip Fisher. Fisher's idea was that you can learn more about a company by talking to its customers, suppliers, and competitors than you can from any annual report. We can create a modern version of this, a Scuttlebutt 2.0 method, designed for the digital age. This is your blueprint for becoming a world-class qualitative analyst. Step 1. Digital listening posts. The internet is the greatest scuttlebutt tool ever invented. Your first task is to set up listening posts for any company you are researching. This means going beyond a casual Google search. Create dedicated alerts and feeds. Go to Reddit and find the main subreddit for the brand. Read it every day. Is it a ghost town of complaints or a vibrant community of fans sharing tips and creations? Go to YouTube and search for the brand. Are the top results corporate ads, or are they passionate reviews and tutorials from real users? The voice of the user is more powerful than the voice of the corporation. Identify the super users and influencers in the space and see what they are saying. These are your digital scuttlebutt sources. Step 2. The real-world safari. You must leave your computer and observe the brand in its natural habitat. This is what Buffett did when he invested in Apple. If it's a retail company, go to the store. Don't just look at the products. Watch the customers. How do they interact with the staff? Do they seem happy, excited, frustrated? What are they buying? Are they carrying the branded shopping bag with a sense of pride? If it's a restaurant, eat there. Listen to the conversations around you. Are people there for a cheap meal or for an experience? If it's a physical product, like a car or a piece of clothing, start counting. How many do you see in a single day? This is actively deploying the frequency illusion. The goal of the safari is to get a visceral feel for the customer's emotional connection to the brand. Step 3. Talk to people. The classic scuttlebutt. This is the most intimidating but often the most valuable step. Talk to actual human beings. If you are researching a home improvement store, talk to contractors. They are the power users and will tell you in no uncertain terms which store has the better service, selection, and pro-level loyalty. If you are researching a software company, find its users at a conference or in an online community and ask them about their experience. Ask one simple, powerful question. If this product were to disappear tomorrow, would you be upset? The answer to that question will tell you almost everything you need to know. A yes indicates a product that has become essential. A shrug indicates a commodity that can be easily replaced. Step 4. Synthesize and question. The final step is to take all this raw, qualitative data from your listening posts, your safari, and your conversations, and synthesize it. Look for patterns. Is the message consistent across all channels? Then, and this is crucial, play devil's advocate. Actively try to prove your own thesis wrong. This is your defense against confirmation bias. If you believe the brand is beloved, force yourself to write down the 3 most compelling arguments against it. This rigorous process of information gathering, real-world observation, direct conversation, and intellectual honesty is the Scuttlebutt 2.0 method. It is hard work. It takes time and effort. It is why most investors never do it. They stick to their spreadsheets. But this process is what gives you a true informational edge. It allows you to understand a business from the inside out, from the perspective of its most important asset, its customers. It is the skill that allows you to spot the next great investment long before it becomes obvious to the crowd. The antithesis to the Scuttlebutt 2.0 method is the path of the 99% of investors, which is characterized by 2 crippling behaviors: analysis paralysis and following the herd. These 2 tendencies, working in tandem, ensure that the average investor consistently underperforms, buying high out of excitement and selling low out of fear. Analysis paralysis is the state of overthinking a decision to the point that a choice is never made. For the modern investor, this is an ever-present danger. We have access to an infinite amount of information: real-time stock quotes, endless financial news, thousands of analyst reports, and complex charting software. The retail investor can feel that they need to consume and understand all of this before they can make a decision. They spend all their time in the noise, the short-term market fluctuations, the quarterly earnings predictions, the minute-by-minute news cycle. They build ever more complex spreadsheets, adding more and more variables, believing that the next piece of data will finally give them the certainty they crave. But certainty never arrives. The result is that they miss the big picture. They are so focused on the quantitative details that they fail to do the qualitative work of the Scuttlebutt 2.0 method. They never get around to actually observing the business in the real world. They don't see the growing lines. They don't hear the buzz from passionate customers, because their eyes are glued to a screen. By the time the company's success is so obvious that it shows up in all the financial data they are tracking, the stock price has already soared. The opportunity has passed them by. The second behavior, following the herd, is often a direct consequence of analysis paralysis. After being frozen by indecision for months or years, the investor finally sees a stock they were researching take off. The financial news is full of glowing reports, Wall Street analysts are all upgrading it to a strong buy, and their friends are bragging about the money they've made. The fear of missing out becomes unbearable. At this point, they abandon all their complex analysis and simply follow the herd. They buy the stock near its peak, not because of their own independent research, but because everyone else is doing it. They are buying the signal after it has been fully amplified into deafening noise. The problem with following the herd is that the herd is notoriously fickle. At the first sign of trouble, a market downturn, a disappointing earnings report, the herd panics. And the investor who bought in based on social proof, rather than deep conviction, panics along with them. They sell at a loss, solidifying their underperformance. This vicious cycle of paralysis, followed by panic, is why so many people conclude that investing is just too hard, or that the market is rigged. The truth is that they are simply using the wrong tools and looking in the wrong places. They are trying to find an edge in the same noisy data that everyone else is looking at. The Scuttlebutt 2.0 investor does the opposite. They ignore the short-term noise. They build their conviction from the ground up, based on primary qualitative evidence of a company's bond with its customers. This conviction allows them to act decisively when they spot an opportunity, even if no one else sees it yet. And it gives them the fortitude to hold on or even buy more when the herd is panicking, because their belief in the business is not based on the fluctuating stock price, but on the enduring strength of the brand. The direct financial connection of being able to spot the signal in the noise is the ultimate reward for all this work. the ability to generate superior, market-beating capital gains. Investing is a game of information asymmetry. The person with better information, or the person who can better interpret the publicly available information, wins. By focusing on the qualitative signals of customer fanaticism, you are developing a source of information that Wall Street systematically overlooks. Professional financial analysis is heavily biased toward the quantitative. Analysts are trained to build complex financial models, and their career incentives are often tied to short-term, quarterly performance. They spend their days in front of a Bloomberg terminal, not in a shopping mall or a Reddit forum. This creates a structural blind spot. The market is very efficient at pricing in known, quantitative information. It is much less efficient at pricing in the soft, qualitative factors we have been discussing. This inefficiency is your opportunity. When you identify a company with a growing army of evangelists and strengthening brand power, you are essentially seeing the future of the company's income statement before it is written. You know that this customer loyalty will eventually translate into higher repeat purchases, lower customer acquisition costs, expanding margins, and greater resilience. You are buying the business based on where its earnings will be in 3 to 5 years, while the rest of the market is still focused on what they will be next quarter. This is how you find a stock that is truly undervalued, not just cheap on a superficial metric. The financial transformation happens when the qualitative signal you spotted eventually becomes quantitative noise that everyone else can see. As the company's zero-cost growth engine kicks in, its revenue starts to accelerate. As its pricing power is flexed, its profit margins begin to expand. Suddenly, the company starts beating Wall Street's earnings estimates quarter after quarter. The analysts who were previously ignoring the stock start to take notice. They upgrade their ratings. The financial news starts running positive stories. The herd of investors who were paralyzed before now stampede in, driving the stock price up. The valuation multiple of the stock expands as the market begins to recognize the quality and predictability of its earnings. You, the investor who did the early scuttlebutt work, benefit from a powerful double whammy. First, you get the return from the company's underlying earnings growth. Second, you get the return from the stock's valuation multiple expanding as the rest of the world catches on to the story. This is how 10-baggers are made. This is the path to truly significant capital gains. It is not about timing the market or finding a clever loophole. It is about identifying a high-quality business with a durable, qualitative advantage before that advantage is fully appreciated by the wider market. This skill, the ability to see the signal in the noise, is the final and most crucial link in the chain. It is the active ingredient that transforms all the theoretical knowledge about moats, growth engines, pricing power, and resilience into tangible, life-changing wealth in your portfolio. You have made it through a deep and rigorous exploration of one of the most powerful principles in investing and business. You have invested your time and your focus, and that investment has now armed you with a new lens, a new way of seeing the world. You now possess a mental tool that allows you to look past the spreadsheets and the chaotic noise of the market and see the fundamental reality of a business, its relationship with its customers. You understand that the most formidable moats are not made of patents or factories, but of loyalty and trust. You can now identify the mechanics of a zero-cost growth engine, distinguishing true organic growth from the fragile, paid-for variety. You have a framework to test for the ultimate business superpower, pricing power. You can stress test a brand's resilience, and most importantly, you now have a practical method for spotting these powerful qualitative signals in your everyday life, long before they become common knowledge. This is a profound advantage. It is a fundamental shift from being a passive consumer of financial news to an active, independent analyst of business reality. But this powerful lens, this ability to see the intangible power of a brand, is only one crucial piece of the puzzle. It is a master key for answering the question of what to buy. It helps you identify the truly wonderful businesses, the castles with the widest moats. However, it does not, by itself, answer the equally critical questions of when to buy and at what price. The most wonderful business in the world can be a terrible investment if you overpay for it. A qualitative advantage, no matter how strong, is not a license to ignore the discipline of valuation. The complete system, the full arsenal of a world-class investor, requires marrying this qualitative insight with a rigorous quantitative framework. The video that is now appearing on your screen is the missing link. It is the other half of the map. It is the bridge that connects the art of understanding a business with the science of valuing it. It represents the next essential layer of knowledge, the principle that ensures the wonderful companies you can now identify are purchased at prices that lead to wonderful returns. Most people will stop here, satisfied with this one powerful new idea. They will add a tool to their belt, but they will not complete the machine. But for those of you who are truly committed to the path of financial freedom, for those who are building a complete and unassailable fortress of investment knowledge, the journey does not end. The choice to click is more than just a choice to watch another video. It is a declaration that you are committed to mastering the entire system. It is the choice to continue your transformation from a speculator into a true capital allocator. The next piece of the puzzle awaits.